There are so many myths in the stock market that I found over 100 just while making this video, but here are the 10 biggest stock market myths that could kill your portfolio. The first crucial stock myth is I can time the market if I'm smart enough. This one destroys more portfolios than almost any other. People think if I just wait for the dip, then I'll buy and then I'll sell before the crash. Sounds simple, right? The problem is, even the best professionals with PhDs and billions of dollars in resources fail at timing the market consistently. Study after study shows that investors who try to jump in and out of the market almost always underperform people who just stay invested. Here's why. If you miss just the 10 best days in the market over 20 years, your return gets cut in half. And those best days often come right after the worst days, when most people are too scared to invest. So, unless you've got a crystal ball, timing the market isn't a strategy, it's a gamble. The second myth, bonds or cash are always safer than stocks. This one sounds true because in the short term, yes, bonds and cash feel safe. They don't crash 30% in a year like stocks can. But here's the catch. Over decades, bonds and cash can be incredibly dangerous because of inflation. If your money isn't growing faster than inflation, you're actually losing wealth every year. For example, $100,000 left in cash in 1990 would only have the purchasing power of about $50,000 today. That's a 50% cut just for playing it safe. Stocks, especially through diversified index funds, have historically beaten inflation and created real wealth. The danger is thinking short term safety automatically means long term safety. The third myth, past performance predicts future results. We've all seen it, a stock or a fund skyrockets and suddenly everyone wants in because look how well it's been doing. Here's the harsh truth. Markets are cyclical. What outperforms this year often underperforms the next. Chasing past winners is like driving while looking only in the rearview mirror. You're almost guaranteed to crash. Remember the dot-com bubble? Tech stocks that doubled or tripled in the late 90s collapsed by 80% in the early 2000s. Or more recently, meme stocks that went to the moon in 2021 mostly came crashing back down to earth. Smart investors focus on fundamentals, not the rearview mirror. The fourth myth, I'll wait until the markets feel safer to invest. This one is one of the sneakiest myths because it feels rational. People say, I'll just hold on to my cash until things calm down. But here's the reality, the market never feels safe. Think about it. In 2008, people said the market was too risky. In 2011, there was the European debt crisis. In 2020, the COVID. In 2022, inflation and war. If you were waiting for the perfect moment, you would have been waiting forever and missing decades of compounding growth. The truth is, the best strategy is to invest consistently no matter what the headlines say. That way, you buy some when prices are high, some where they're low, and over time, you average out at a great price. That's called dollar cost averaging, and it beats waiting on the sideline every time. The fifth myth, I can get rich quick if I just find the right stock. This one might be the most dangerous. It's what drives people into penny stocks, meme stocks, and hype coins. Yes, you might hear stories about someone who turned 1,000 into $100,000 on a single lucky bet. But for every one person who does that, there are thousands who lose everything chasing their dream. Building wealth in the stock market is not about hitting home runs. It's about hitting single and doubles consistently. Investing in broad markets, reinvesting dividends, and letting compounding do the heavy lifting. The get rich quick mindset is what turns investors into gamblers. Now, let's move into the rest of the myths that are just as damaging. The sixth myth, investing is just gambling. A lot of people think stocks are no different from pulling a slot machine, but here's the difference. Gambling is zero sum, meaning someone wins and someone loses. Investing, when done correctly, is positive sum. Companies grow, economies expand, and everyone who owns a share benefits. Yes, if you speculate on random stocks with no strategy, you're gambling. But if you invest in productive companies, you're buying a piece of real value creation. The seventh myth, I need a lot of money to start investing. This stops people from ever beginning. They think, once I have $10,000 saved, I'd start. But by then, they've lost valuable years of compounding. Thanks to fractional shares, ETFs, and apps, you can start with as little as $5 to $10. The point isn't how much you start with, it's that you start early. Compounding is like a snowball, it grows bigger the longer it rolls. The eighth myth is the stock market is too risky, I'll lose everything. As we discussed a little about earlier, yes, stocks crash, sometimes 30% or more, but history shows they always recover. The real danger isn't volatility, it's staying out of the market and missing long term growth. The ninth myth is high returns mean it's a good investment. Big gains spark FOMO, but high returns usually mean high risk. The higher it flies, the harder it can fall. Good investors don't chase hype. They focus on risk, diversification, and a long term fit. The 10th myth is I should only invest in companies I know and like. Loving a company doesn't mean it's a safe bet. Even giants like Kodak and Blockbuster collapsed. That's why diversification is essential, no matter how much you like a single stock. Now, one thing you absolutely cannot afford when investing is inaccurate data. That's where the sponsor of this video, EODHD, comes in. They're an API key provider that delivers the latest and most reliable financial data, perfect for your Excel sheet or even your next app idea. Definitely check them out. The link is in the description. Thank you so much for watching. Now, if you want to know why I actually broke one of these myths and went almost all in on a single stock, watch this video right here.